Bro, Meesho IPO is finally here. GMP is exploding, retailers are going crazy, and social media is filled with only one question. Will Meesho make us money or will it become another overhyped disaster? Today, I'll show you the exact numbers, the real GMP movement, what big investors are whispering, and what retail is blindly believing. And at the end, I'll give you the clearest, apply or avoid, breakdown. But the final decision is yours. Let's begin. The reality check. First, the hard facts. The Meesho IPO opens 3rd December and closes 5th December, with tentative listing around 10th December. The price band is 105 rupees to 111 rupees per share and the lot size is 135 shares. So a single retail lot will cost you roughly 14,175 rupees to 14,985 rupees depending on the band. The total issue size is about 5,421 crore rupees, which includes both a fresh issue and an offer for sale block. All of these details are in the RHP and exchange listings. Now, the market buzz. Grey market premium trackers and business press are showing GMP in the range of about 33 rupee to 42 rupee today, which implies a rumored listing price around 140 rupee to 153 rupee if the upper band holds. Remember though, GMP is unregulated sentiment, not a promise. Why everyone is talking about Meesho? Meesho is built for Bharat. Unlike premium marketplaces that chase metro customers, Meesho's customers are primarily in Tier 2 and Tier 3 towns. The company focuses on ultra-low price items, a huge reseller ecosystem, and low-touch logistics. It is effectively an asset-light, social commerce engine that connects micro-sellers to price-sensitive buyers. Because of this low-cost model, Meesho has been able to scale order volumes aggressively. That explains the investor excitement, large untapped markets, high order frequency, and a potentially sticky reseller base mean big growth is possible. Reuters and LiveMint note Meesho's transacting users and GMV growth have been strong recently, and revenues rose sharply in the past year while reported losses narrowed significantly. Signs the company is moving towards operational maturity. The financial truth. Numbers matter. For the first half of fiscal 2026, Meesho reported around 55.78 billion rupees in revenue, a near 30% year-on-year top-line increase, while losses narrowed by more than 70% compared to the prior period. Gross merchandise value, GMV, is up and order frequency is rising, which shows demand is real. But they are not profitable yet, margins are thin, and the path to sustained profit requires constant scale and strict cost control. The IPO proceeds, a large chunk of the 5,421 crore rupees, will go into technology, logistics and marketing to deepen market reach and reduce product costs. That's a reasonable use of capital. But it also means the company will likely continue reinvesting heavily in the near term, delaying consistent free cash flow. Strengths that can make Meesho win. Here's what I'd give Meesho credit for. First, massive penetration into smaller cities where e-commerce is still growing. Second, a reseller engine that creates distribution without heavy capital. Third, an asset-light model which, at scale, can lift margins. And fourth, a brand recall among value shoppers. These are structural advantages that make a strong long-term case if Meesho executes on logistics and seller finance. If they turn the current revenue momentum into consistent unit economics, the upside is big. The real risks that can make it flop. Now the cold side. Low price points mean razor-thin margins. Logistics or return cost shocks can wipe the profitability strategy almost overnight. Competition is another problem. Amazon, Flipkart, and the entire Reliance engine are not sleeping. They can use cash to subsidize prices aggressively. Also, remember that the IPO size itself can dilute enthusiasm among institutional buyers if they don't see convincing near-term profit metrics. And GMP, that tempting number, can evaporate in a heartbeat if market mood changes. So this is not a safe, cash cow IPO. It's a growth gamble. The GMP game. Let's be very practical about GMP. If GMP today is say 35 rupees to 40 rupees and the upper band is 111 rupees, that implies an expected listing price near 146 rupees to 151 rupees. Many retail traders therefore assume a near-term 35-40% pop. But GMP is unofficial and can be manipulated by early speculators. If you chase a 40% expected listing gain by applying heavily, You risk the outcome if sentiment flips. Treat GMP as a signal, not a guarantee. Use it to understand market mood, not to base your life savings. Scenario and sensitivity analysis. Okay, let's model 3 real scenarios so you can choose a path. Scenario A, bull case, GMP holds. Listing at 145 rupees to 155 rupees. If you applied at 111 rupees, a listing pop could be 30-40%. That's short-term gains, good for bite-sized speculative money. Scenario B, base case, tepid market listing near 120 rupees to 130 rupees. That's a 8 to 17% listing gain or flat from the upper band, acceptable for cautious traders, but not spectacular. Scenario C, bear case, market shock or negative news listing below 105 rupees to 110 rupees, GMP collapses, and long-term depends on execution. This can result in immediate paper losses and whiplash. Now the sensitivity. If logistics costs rise by just 5% across the platform or return rates increase by 2 to 3%, Meesho's unit economics could swing negative again, and that will be punished by the market hard. So the margin of error is thin. Good execution is essential. My action plan, 3 clean options for viewers. Here are 3 simple paths you can pick depending on your capital and risk appetite. I'm not forcing a decision. The final call is yours. Option 1. Speculative short-term. Apply small, target listing pop. Apply for just 1 to 2 lots if you want to try for listing gains. Assume tilde 30 to 40% upside possibility. Keep position size small. No more than 1 to 2% of your tradable capital. If listing pops, consider booking partial profits quickly. Option 2. Hybrid investor. Apply selectively. Hold small for long term. Apply 1 to 3 lots but plan to hold only if the price post-listing stabilizes and you see early signs of margin improvement. Think of this as a 3 to 5 year high-risk allocation, not as cash you need next month. Option 3. Conservative. Skip IPO. Wait for listing or correction if you are risk-averse or capital preservation matters. Skip the IPO and watch the listing. If it drops to a rational valuation post-listing, you can buy later with better risk management. A few practical rules I always follow. Do not invest more than 20% of your trading capital in a single IPO lottery. Never use borrowed money, no margin, for IPO speculation. And set a pre-decided exit. If listing shows a 30% pop and you're a speculator, decide beforehand whether you will sell 50% or 100% gains. Finally, a real, immediate checklist if you plan to apply. Confirm your UPI mandate is active. Check lot size and funds, apply at upper band only if you accept valuation, and do not chase GMP, chase your risk rules. So what am I doing? I likely apply a small amount for listing participation, not because I'm certain, but because the probability of a short-term pop is high and I can afford volatility. For long-term, I will watch the first 30 to 60 days of execution metrics. If order frequency and margin improvement are sustained, I will add gradually. Tomorrow I will upload a live listing day plan. Exactly when to sell, how to read the opening ladder, and real-time signals to watch on day 1. If you want that live playbook, subscribe and hit the bell. Remember, the final decision is yours, and your capital is sacred. Trade smart.